some lenders can get you approved while other lenders can't. It doesn't seem like it should be possible that way. So why is it that some are willing to lend you more money, others can't? Or what exactly is going on here? Well, let's dig in a little deeper and let's go see what a pre-approval is, what it takes to get there, and exactly what it is some of these lenders are missing when others aren't. So if we take a look at it, we see that pre-approvals only consist of 4 items. You got your assets, your liabilities, your income, and your credit scores, right? And what makes up your credit scores. And so going through and looking at this, let's take a deeper dive and just dig into that to see what we have. So your assets will consist of like your bank statements, your retirement funds. It's the income that you need to satisfy your down payments, your closing costs, right? What the lender needs from you upfront to say, hey guys, he has the funds set around or she has the funds set around to make them seem less risky. Okay, so again, we're looking at bank statements or retirement funds, gift letters, gift funds, life insurance policies, or your stock bonds, right? Now, the secret is in order for you, before you get a pre-approval letter, your lender should be asking you how much of these funds are liquefiable. Can you pull from your retirement account, your life insurance policy, or can you take loans against them? Oftentimes, that's my favorite part, is taking a loan against these assets so you don't actually have to pull money out of it. You just borrow against it. Once you borrow against it, you're borrowing money from yourself, so we don't have to count that against your debt to income ratios. And it's typically cheaper to borrow money from yourself than borrow money from a bank. Now, if you get gift funds can come from your mom, your dad, your brother, your father. Your employer can give you gift funds. If you're a Native American part of a tribe, they can give you gift funds, right? And so these are all excellent options, but keep in mind, they need to be liquefiable. You have to be able to grab them, access them right away. So let's look what's next. We got our liabilities, our monthly debt, things that we are sending cash out every month. And student loans, car payments, installment loans like, personal debt, right? Now, are you paying alimony? Are you paying child support? Do you have a ton of credit card debt that you're paying? All this stuff gets counted. We're going to look at this information and we're going to send it out and put it into calculators and understand if you are a good credit risk or not. Now, income's a very touchy subject, not really touchy so much, but there's different types of income. There's part-time income, there's full-time income, there's self-employed income, there's retirement income, right? And so what type of income do you have? The lender needs to understand how they can access it, right? Are you getting alimony? Are you getting child support? Are you living off your retirement funds? How much do you have? Is it coming in monthly? Is it coming in bi-monthly? Is it Social Security funds? Can we gross it up? There's a lot of questions that come with income, but just some of the biggest questions that you need to understand is we look at how long you've had a work history. Is your income pretty predictable, right? Are you working 29 hours this week, 31 hours next week, 46 hours the following week? And if you're paid hourly, that's known as variable income. Now we need to look at variable income over a longer period of time so we can determine how much your average is for receiving variable income. If you're getting 40 hours this week, 40 hours that next week, and 40 hours, and always 40 hours, always 36 hours, hey, guess what? That's not variable. That's predictable. We can run with that. If you're self-employed, plan on 2 years. Every now and then we can get 1 year tax return self-employed. But if the system doesn't call for it, the automated underwriting system calls for 2 years, you're going to be stuck with 2 years. So plan on self-employed 2 years. Plan on being in that line of work for 5 years, guys. 5 years. You need to be in that line of work. And then 2 years of self-employed. Okay. Now we're going to look at credit reports. On credit reports, we're looking at foreclosures, bankruptcies, judgments, derogatory accounts. How long have you had a credit history? Have you been managing your credit cards responsibly, paying them on time? This is all things that we look at, and we want to make sure you're doing well. And here's the thing. Here's the reason why most people get different pre-approval letters from different lenders, because not every lender goes in this detail. Some lenders have a quick conversation with you on the phone and they're like, cool, send you an email with a pre-approval and you're good to go. Only problem is you're not good to go because they haven't verified your income. They haven't verified everything in there. And they won't verify it until you've already got under a contract, made a commitment to a seller to buy their house, and they start taking your information and sending it to an underwriter. That puts you in a hard spot. That puts the sellers in a hard spot. So you want to make sure you get a strong pre-approval letter up front so that you're confident going in that you can buy this house and close your loan in just a few weeks.